Today, there was an updated video breakdown that I posted 2 days ago going over the order flow in detail on XRP, specifically stating and giving accurate targets and updates for you all that we needed to see. Okay, so I don't have too much time today, so I'm not going to be able to go over all of my trade positions today. A couple of different buy scalps I took. Overall, the market sentiment today, both in crypto and in futures, was risk off. And so I just want to paint a clear perspective for you guys as to why that was via the fundamental backdrop. So we're going to touch on that real quickly, and then we will head off into the weekend. Aqua's Zoom call will be here in an hour or two. So, just starting off with the backdrop for today and some things that we had updated you all on in previous Zoom calls. The first one, obviously, of course, going all the way back to October 6, 2025, when the market was trading at the institutional dark pool at about 4.24 trillion, and we were calling for the current pullback that we are currently living through and some of the drivers that would likely stem or create a risk off environment. And these fundamentals are still fundamentals currently lingering in the sentiment today. You can see things like hawkish Fed commentary, any shift away from rate cut expectations in the FOMC minutes, Powell's speech we talked about back then. We talked about the prolonging of the US government shutdown or any delays in data releases and political uncertainty that could dampen investor confidence. We mentioned any Bank of Japan policy surprise or any continued expectation of rate hikes from the Bank of Japan that could disrupt global carry trades and trigger risk aversion. So, some of these things that we talked about in previous videos are still ongoing today. Now, in yesterday's call, Aqua had asked me the question at the end of the call, do I think that the ETF launch today in XRP or the active ETF launches today was going to lead to some type of rally in XRP's price action? And I gave my personal and honest opinion, and I said no. I said that most likely it's going to have no effect on price action whatsoever. That in terms of the order flow and in terms of the dark pools and deltas, we weren't seeing any bullish price action on XRP, and that the likely outcome of the release of the ETFs was actually going to be some form of sell pressure. We can see that currently unfolding today. There was an updated video breakdown that I posted 2 days ago going over the order flow in detail on XRP, specifically stating and giving accurate targets and updates for you all that we needed to see a break above and a sustainable hold $2.61 and see buyers turn this area of interest into support in order to see any higher prices on XRP. Now, fast forward to today, we can see that that dark pool has held relatively well as a resistance. Price has failed to break above that, and we are starting to trail our way back down to either the buy base here or possibly lower targets, which again, I still have on my charts, on my radar, some dark pools that rest at about $1.90. I don't know why those are not on my charts. I'll go ahead and clone that and put that there. There's a dark pool that sits at about $1.90, and there's also another dark pool that sits at about $1.56, where I will continue to look for some good DCA positions on XRP if those targets do materialize and come into fruition. Nonetheless, the accurate update and analysis that I've been giving you guys has proven exactly that, accurate. So I'm hoping that you guys have been paying attention. And then also in the other day's Zoom call, I mentioned specifically the percentage probability that the Fed cuts rates in September. If you go back and you look at a report that I dropped for you guys in the fundamentals section, when I had typed it out for you all, and we had talked through the possible scenarios if we were to get the data, I specifically mentioned in this little tiny piece here that if we start to see a higher for longer environment, if we start to see rate cut odds dwindle or drop below 70%, that we would most likely see sell pressure in risk assets. All right. And so we're seeing that reflected in price today. So let's talk thoroughly through that landscape so that way you guys understand what's going on and why we're seeing sell pressure in both equities, futures, crypto. So today was one of those sessions that perfectly captures why macro matters, why sentiment drives flows. and why you never trade headlines at face value. On paper, yesterday, the US government reopening should have been a positive catalyst. And yesterday, even we saw that classic relief rally, which was a clean buy the rumor, sell the news reaction. As soon as Trump signed the bill to end the shutdown yesterday, rolling into Asia session, we saw the markets start to gain some traction. But today reminded everyone why markets don't care about the headline, they care about the implications behind the headline. And the implications today turned out to be far more uncertain, far more hawkish, and far more damaging to risk sentiment than the initial relief rally suggested. So just reading some of the screenshots from some of the fundamental reports that I've gathered for you guys, it clearly says here, ending the longest federal government shutdown in U.S. history and allowing government operations to resume. However, the White House cautioned, that's a key vocabulary word right there, that October's official jobs and inflation reports, key indicators of U.S. economic health, may be delayed, leaving investors to rely yet again on private reports to gauge the U.S. economy. So, going over some factors that are currently weighing on the market sentiment. As we can see clear as day, crypto is down roughly about $119 billion. Futures markets took an absolute crap today. The Nasdaq dropped, and so did the S&P 500. Outside of that, though, however, I'm still bullish long term in the total cryptocurrency market cap after all of this risk off sentiment subsides. In this report, I will talk about and uncover some of the things that I'm still being mindful of as we head into the end of the year. So first, buy the rumor, sell the news. The shutdown ending was not the bullish catalyst yesterday that the markets had been expecting. Yesterday's bounce was all positioning traders covering shorts into the announcement, algos reacting to the word reopen, and a temporary sense of clarity. But today, the reality set in. The shutdown ending didn't solve anything. In fact, it actually created a new layer of uncertainty because the government data may not be released at all. The White House has openly stated that the October CPI and October payrolls might never be released. They said that the federal statistical system may be permanently impaired and that policymakers may be flying blind. This is a very key important vocabulary word right there, via something that Jerome Powell said at the last meeting. So for markets, this is a nightmare. When the Fed doesn't have any data, the Fed does one thing. It slows down decision making. It becomes more cautious, and caution equals fewer cuts, which equals risk off sentiment. Here's a statement directly from Jerome Powell at the last FOMC meeting. The lack of government data is a temporary state of affairs, Fed Chair Jerome Powell said on October 29th. If you ask me, could it affect the December meeting? I'm not saying it's going to, but what do you do if you are driving in the fog? You slow down. And so think about this logically. If everybody was anticipating the government shutdown to end and we were going to get this euphoric rally because of all the data releases that we were supposed to get, but now they're saying after the government shutdown has ended that we're not going to get any data. And the last commentary from Jerome Powell that we got was that he's most likely going to lean more so towards holding interest rate cuts. If they don't get any data, then what do you think the market's going to start pricing in ahead of time? Exactly that, right? And so we're starting to see that shift from risk on that previously existed to now risk off. Yesterday's optimism flipped into fear, not because the shutdown ended, but because traders realized that the shutdown left a hole in the data that the Fed heavily depends on. This is why I always stress to you guys, uncertainty is worse than bad data. Number two, rate cut odds collapsed. If you guys remember, like I mentioned in this update, we talked about the odds of a rate cut hovering at around 70%, and I mentioned that if the odds dwindle below 70%, it would likely reflect itself in sell pressure and risk assets. Today, again, we're seeing exactly that. Here you can see in the report, market expectations for another 25 basis point cut from the Fed next month currently stand at around 54%, down from nearly 65% a day earlier. In a previous Zoom call, like I said, I mentioned if December rate cut odds fall below 70%, expect risk sentiment to weaken. Today, we saw that play out in real time. Screen showed 65% odds of a December cut. yesterday, and today they hover at around 54%. Some outlets like Reuters and Bloomberg mentioned that they hover just over 50%, between 50 and 54%. This is a major shift in sentiment. Crypto alone shed over $100 billion in market cap. US futures saw steady intraday selling. Mega caps traded mixed and tech leaderships fade. Rate cuts have been the backbone of the risk on narrative since Q2. You can see that in some of the data reports. Rate cut hopes drive Bitcoin higher. Fed rate cut hopes. Bitcoin moves above 112,000 as the US Fed rate cut hopes rise. Data says that rate cut hopes soar, like you guys can see it all in the headlines, and now that sentiment is completely shifting. So once the market sensed that those cuts may be delayed or worse, removed, risk assets tend to pull back, which we've covered in previous calls. On top of all of that, today we had multiple Fed speakers, which we mentioned to be mindful of and paying attention to. And here in our November 9th report, from this live call that I had with you guys, that I posted publicly, reading this report to the general populace, I had mentioned in this report that if we saw any hawkish Fed rhetoric, it would likely lead to a risk-off scenario. And sure enough, today we're seeing that exactly unfold. So the number three scenario, or the number three thing weighing on sentiment today, the Fed delivered a wall of hawkishness today. 4 Fed speakers all leaned against rate cuts. This was the second heavy blow. Instead of using today to reassure markets, the Fed did the complete opposite. We got hawkish signals from Kashkari, from Hammock, from Daly, and from Musaleem. Kashkari said that inflation is still too high at 3% and labor markets are under pressure. Hammock said that inflation is too high and moving up, employment weakening, tariffs will drive inflation early next year. That was a really bad comment right there. This one, because can anybody tell me what this comment right here leans towards? Starts with an S, and it's a word that risk assets do not like. We've talked about it before.
Stagnation.
Close, Ron.
Stagnation.
Yeah, stagflation. Yep, stagflation. Stagflation, very simply put, you could go to any type of economic fundamental report or just Google it. It's literally just when inflation does not decrease, it continues to remain elevated, or increases, remains stubborn and sticky. And on the flip side, the labor market or the overall economy weakens. And it puts the Fed in a very tight place because they cannot cut rates in that type of environment. Daly said that there's still work to do to get inflation to 2%. That means, again, that they most likely will have to hold higher for, or hold rates higher for longer. That there's a premium on waiting before cutting. And Musaleem said that they should be proceeding with caution, limiting room to ease further because inflation is still too high. So each of the Fed speakers today mentioned possible prospects of higher inflation. We obviously, of course, don't know that because we're not getting any inflationary data. But to clash with all of this, we are seeing the possibility of higher inflation due to the outcome of the tariff debacle between Trump and the Supreme Court. So to finish this, not a single Fed official leaned dovish. Not one suggested December cuts were on track. Not one implied the shutdown-related data fog should be ignored. This synchronized hawkish tone on the same day rate cut odds fell created the perfect storm for markets to bleed as larger investors de-risked. Data fog after the shutdown, again, equals the Fed flying blind, which usually equals no rush to cut rates, which the market was previously leaning on via the rally that we saw in 2025. One of the biggest risks now is the data vacuum. October CPI is not expected. October NFP is likely not coming. September data is likely to be delayed. October government surveys still missing. And inflation and labor data still impaired. So until any of this changes and comes out supporting the rate cut narrative, we are still likely to remain in this type of sell pressure environment. Powell, like I mentioned, literally warned that if you're driving in fog, you slow down. This commentary means that there's less urgency to cut rates, potentially holding in December, which I personally think, unless we see any substantiating data that says otherwise, that is going to be the likely outcome. and then continuing to delay rate cuts until we get more supportive data heading into 2026. This is why traders aggressively repriced rate cut expectations today. And once the Fed loses visibility, the markets loses visibility, and uncertainty is poison for risk assets, which I've mentioned multiple times. On top of that, Japan enters the macro picture. A weak yen now threatens a Bank of Japan rate hike. The Japanese yen added another layer of pressure today. Here you can see it says, Japanese Prime Minister, I'm not going to butcher this lady's name, on Wednesday expressed her administration's preference for interest rates to stay low and asked for close coordination with the Bank of Japan. The same day, Japanese Finance Minister Katayama gave a new verbal warning on yen weakness as it approached the 155 paired against the dollar, noting one-sided and rapid movements in foreign exchange markets. A weak yen could force the Bank of Japan's hand, leading to a rate hike next month. If you guys remember last year in July, when the Bank of Japan was forced to hike rates, they surprised the market with the 50 basis point cut, and it led to aggressive unwindings of the yen carry trade and rapid yen strength. If we were to see another scenario like this year or heading into 2026, it is likely to have similar results, something that would likely weigh on risk sentiment. Right now, however, Japan's PM wants rates low. Japan's finance minister issued a new verbal warning. These are all just some of the notes. As yen nears the 155 mark, intervention risks grow, as Japanese finance ministers had mentioned that if the US dollar paired against the Japanese yen, if it strengthens above the 155 mark, that they are going to intervene, right? So just be mindful of that. Markets now see a 22% chance of a Bank of Japan rate hike in December and a 43% chance by January. As I mentioned here, a yen shock or a Bank of Japan hike would likely strengthen the yen sharply, unwind the yen carry trades, force global deleveraging, drive risk-off sentiment across crypto and equities. Number 6, tariff uncertainty. This is a very big thing right now. The Supreme Court case could be a major macro catalyst. This, in my personal opinion, is the sleeper risk catalyst right here that I'm personally watching closely. A ruling against Trump could lower consumer costs, which would be positive, but force the government to refund up to $89 billion in collected duties, trigger economic turmoil, spike inflation. I highlighted that in bold because that would be the worst outcome, and force the Fed back into a hawkish corner. Bank of America said a ruling against Trump may raise inflationary pressures. The last thing that the markets need when the Fed is already fighting stubborn inflation. You can see that here. It mentions a ruling against the tariffs would likely lower the cost burden to businesses and consumers, but the economy could face economic turmoil if the court demands the administration refund tariff revenues. Country-specific duties totaled approximately $89 billion through August, according to the government data. A ruling against Trump may end up boosting consumer inflationary pressures, Bank of America analysts said in a note published last week. So this is yet again a highlight that supports the possible stagflationary narrative. Economic turmoil coupled with higher and stubborn inflation, which will be the worst case scenario for risk assets. Moving forward, any turbulence around tariffs will likely continue to increase risk-off measures until clarity emerges. So putting this all together, why the market was down today. If we zoom out, today was not random. It was a classic confluence of major macro headwinds hitting all at once. The shutdown ended, which triggered a buy the rumor, sell the news event. Yesterday, we saw the markets become a little bit euphoric that the government shutdown was going to come back online. Uncertainty skyrocketed due to missing CPI and NFP reports. Fed speakers today delivered aggressive and hawkish commentary. Rate cut odds plunged below the 70% threshold that we previously mentioned needed to hold weight. Japan rate hike speculation increased, and tariff legal battles reintroduced uncertainty and inflationary risks into the narrative. Crypto losing over $100 billion in 24 hours was not manipulation like most people are probably saying on Twitter. It was just macro repricing. My personal take forward is that Today was a reminder that the bull markets do not move in straight lines and macro events can override local fundamentals in crypto. Going forward, I'm focused on rate cut odds. If they stay below the 65 to 70% threshold, risk will likely stay weighted and heavy. Inversely, if we start to pop back above the current percentage probability and we see it jump back above 70% due to any data releases or any rhetoric from Fed speakers, we could start to see a recovery in risk sentiment. I'm also paying attention to the Bank of Japan December/January meeting and any possible yen shocks that could lead to any downside risk. I'm being very attentive to the Supreme Court ruling on tariffs surrounding Trump and any inflation expectations or implications that those rulings might deliver. I'm paying very close attention to any of the CPI and jobs data that we could possibly get. Again, it's not guaranteed that we're not going to get it, but it is also not guaranteed that we are going to get it. So I'm being very attentive to if we get that data, and if we do get that data, reverting back to the scenarios that I gave you guys in this breakdown here for the possible outcome once we do get that data, if we get it. Last but not least, how the Fed speakers behave ending November and heading into December to wrap up 2025. We need to remember at all times that this environment can flip very quickly, but as long as uncertainty remains, the market will likely trade cautiously. So that is it for today's fundamental backdrop. That is everything, in my personal opinion, via what I read today that weighed on market sentiment. I'll leave the floor open for any questions if you guys have any commentary. Hopefully the updates that I've been giving you guys in the chat have kept you guys in the loop with what's happening, so that way you guys aren't confused and bedazzled as to why your portfolios likely are performing just as poorly as mine if you're holding digital assets. Mind you, again, you see time and time again the rhetoric around the euphoria from uninformed retail investors that constantly think that prices are going to go higher, that ETF announcements or this, and that are going to drive sentiment. We have to understand that, again, 98% of the activity, the volume, the money that's flowing through the digital asset ecosystem right now is due to trading. That means that the institutions that are participating in the digital asset ecosystem right now are usually risk-weighted or risk-adjusted institutions. That means that they're not going to hold risk assets or trade them via buys if the market sentiment does not favor a risk-on mood. And so they're going to likely hedge against that. We're likely probably, I didn't even check, but gold was probably bullish today. You could probably go over to TradingView and probably see that. Dollar was relatively weaker. Crypto was relatively weaker. Stocks were weaker today. Gold was probably higher on the day. Outside of that, though, that's all that I have for you guys. Real fast before I let D'Angelo go and I leave the floor open for questions. Just taking a real quick look at some updated levels on XRP if you guys have not updated your dark pools. We failed to break above that $2.61 threshold. I'm still being mindful of this delta that currently exists at around $2.21 to $2.06. How the market reacts if sellers push price back down into this area and how buyers defend if they do. Presumably, I would like to see buyers start to accumulate orders, trap sellers at lows, become aggressive enough to start to break previous resistances and turn them into support, and start to trail and make our way back up into the $2.61 threshold. If we can see that happen, then I would like to start to see the same thing unfold at $2.61. Buyers able to overpower sellers that are trying to make an attempt to defend and trap them at highs. Buyers turn that into a support, trapping sellers, becoming aggressive, and breaking prices higher. Until we can see a break above $2.61 on XRP, I'm not personally expecting any higher prices. If at any point in time we do, the next institutional sell delta comes in, or dark pool, comes in at about $2.83. The highest dark pools, mind you, again on XRP, in case we ever did see some type of excessively bullish outbreak, come in at about $4.44 and $5.17, where I will 110% be taking advantage of possibly selling out of some XRP positions. To the downside, if sentiment were to worsen and we were to get those worst case scenarios that we've been discussing and talking about, and sentiment continues to dampen heading into 2026, I'm still keeping a very close eye on $1.90 and $1.56 for some possible DCA levels. How that would look, again, most likely if sellers continue to put pressure on buyers and they overpower them at $2.06. If buyers cannot defend and trap sellers at lows, we're likely to see buyers get trapped at highs. We're likely to see the $2.06 range turn into resistance, and we're likely to see the $1.90 region come into fruition. If $1.90 does not hold, mind you, I will be buying some XRP if that level does come into fruition, then $1.56 is on the table. Outside of that, that's all that I have for you guys in terms of today's update.